Good afternoon, my people. What is going on, Wealth Our Way Nation? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I welcome each and every one of you to episode 143. What is hyperinflation? Before we get into all that, though, I got to practice the attitude of gratitude and thank each and every one of you who are here with me live as I stream across the Facebook Wealth Our Way page, the YouTube Wealth Our Way Network page. Please subscribe to the Wealth Our Way Network page on YouTube, good folks. I also want to give the Wild Nation salute to every member of Wealth Our Way Nation who watches our recording, our pre-recorded program overnight, over the weekend, wherever they can squeeze 15 minutes of financial literacy in, and then the heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. So I've had a very adventurous weekend, FYI. I'm literally just getting back to Georgia. I rode my motorcycle, who is also named Georgia, from North Jersey to Alpharetta, Georgia. I tried to do it all day Sunday, but Sunday it was freezing temperature, so I had to stop in Maryland. Got up yesterday in Maryland to continue on, got as far as a little bit south of Richmond, Virginia, only to have my bike, Georgia, stop riding. I posted about it on my first personal Facebook page. It was a repair, an enhancement to my bike. I got 8 hanger handlebars, and in maybe about 5% of the cases when you have those handlebars put on your motorcycle, there is a way that the wire has to go through the handlebar, and sometimes it gets caught in the fold of the handlebar. Happened to me. My throttle stopped working. Fortunately, Harley Davidson, great brand. I broke down 20 minutes away from a Harley Davidson dealership. Shout out to the good people in Colonial Harley Davidson, Prince George, Virginia. They got me back on the road. They stayed late, and your boy Big Tank was able to make it to Charlotte last night. Woke up this morning, 6 something, did some things, got on the road, hit some traffic, but I'm here. And here to bless you guys on this topic of hyperinflation. Before I get into that, though, do know tomorrow night on the Financial Power Hour, we are going to have a dynamic guest. Actually, 2 guests, 2 dynamic guests. There are a couple. I'm sure you have at this point seen the flyer. I'm not going to, I like to not brag and say names until it's time. But this couple, both influencers, both dynamic personalities, they are not only a couple of people, but they're a couple together. And we're talking about maintaining work-life balance when you actually work with your significant other. It's going to be a great show. Please be here tomorrow night, 6 p.m. live, Wealth Our Way Network on YouTube, Wealth Our Way page on Facebook to watch The Cost of Love, Doing Business with Bay. So with that being said, let's jump into hyperinflation. I want to give you a definition of hyperinflation. A lot of the information I'm going to tell you today, I got from Investopedia. I've also read a couple of articles on MSNBC and Forbes. And basically, also because I went to college for finance and actuarial science, I also had economics as a core study. So I've did some research on the Temple University School of Business site for economics, just to make sure I was consistent with the definition of hyperinflation. So hyperinflation is something you rarely ever see in a developed economy. And by developed economy, we live in the most robust economy. I can't call it the most developed because it's not the oldest economy, of course, but we are generally considered the gold standard, no pun intended, for economic viability by every other nation when it comes to a country that has its own currency like we do. So we are a very established economy, and you do not normally see hyperinflation in a developed economy. Hyperinflation is basically when the inflation, let me back up a little bit. You guys should know all about inflation because I've been talking about it for the past year. I'm the one, not say I'm the only person in the country, but I predicted that we were going to have serious inflationary pressure here in the United States based on the stimulus packages that have been going on. And it's bad. I mean, it's really, really bad. But hyperinflation would be 1,000% in the course of a year of inflation. So 100% means prices have doubled. 1,000% means that prices have went up 10 times the amount that you're thinking that they were last year. So let's rule out from the start any thought that there's going to be hyperinflation in America. But we don't need it to be hyperinflation for us to be concerned. The reality is that, let's take something as simple. Do you see my ceiling behind me? So my ceiling is peeling. I rent a condo down here in Georgia. I started renting it in Christmas Eve. It's the first time I've rented in forever. I've always been a homeowner, and that would normally be my responsibility, but now it's not. It's my landlord's responsibility. And it's been that way now for 2.5 weeks. It's actually not only in that spot, it's in another spot that you guys can't even see. And my landlord keeps telling me he can't get someone to come fix it. And he told me if I fixed it, he'd pay me. I'm not fixing it. That's not what I do. But it goes to the story of what I'm telling you today about hyperinflation. We have an issue in America with labor, with the supply chain. And now, as a result of that labor shortage and that supply chain just jammed up because there's not enough people to produce the goods that we need, prices are rising. The relationship between supply and demand is as supply shrinks, even if demand does nothing, demand would grow in return to the amount of goods because the supply has shrunk. So if we have a demand for 10 items and it went from there being readily available 10 items to now there's only 5 items, we have twice as much demand, if that makes sense to everyone. So we have things like trying to get a handyman to come to your house to spackle the ceiling. I don't know what he's going to do with that, but we can't get people to do work. And this happening all across. We have a shortage of police officers, a shortage of teachers, a shortage of the people who work the highway that you normally see. I'm not really sure why people are not working, other than to say that the government has injected so much money through unemployment benefits, tax incentives, and just stimulus dollars that people are finding it that they can stay home and still get the same amount of money that they were getting beforehand. Here's the problem with that. When you put excess dollars into an economy, which is what America has done, prices will rise because people who are in business and who are selling goods realize there's an influx of cash. People are going to be spending. They can afford to raise the prices because demand will still be there. That would be purposely inflating the price. Then there's the actual need to inflate the price that comes along with a supply chain shortage, with a labor shortage. So we are having, in effect, a double whammy. We are having limited resources and more dollars vying for those resources. So when I say hyperinflation is 1,000% in a year, let's talk about what the inflation looks like for America, so you can get an idea that even without hyperinflation, we still have some concerns. So the U.S. Federal Reserve System says that an annual inflation rate of 2% is most consistent with the Federal Reserve's mandate for maximum employment and price stability. So basically, we like to see inflation set at 2%. In 2021, last year, inflation was 6%. So remember when I said 100% means it's double? So it was 300%, what we'd like it to be. 300%. It's not 1,000, but 300% is not good. So it's a third of what we would call hyperinflation. Let's put that in perspective. In 2020, inflation was 1.2%. In 2019, it was 1.9%. Now, the highest rate of inflation since in the last decade was 2011. It was 3.5%. Right now, in 2022, we are seeing 7% already through the first quarter of the year. So there's a chance we could have double-digit inflation. And what does that mean? Let's talk about some goods and services that, if we saw what hyperinflation looked like, what these goods and services would look like versus a 2% inflation. A cup of coffee, $2 in 2020. With 2% inflation in 2021, that cup of coffee is $2.04. With 1,000% inflation, that cup of coffee would be $22. A gallon of milk, $3.50. With 2% inflation, it's $3.57. That's not too bad, right? Hyperinflation, $38.50. Let's talk about where we live at. $2,000 for an apartment. 2% inflation, $2,040. Hyperinflation, that apartment would be $22,000. We're already starting to see some things like gas go higher and higher. Food is going higher and higher. This money that everyone receives, stimulus money, benefits through taxation breaks and credits, benefits through unemployment. This money, I pray you used it to pay down debts or to invest. If you spent it, Katie, bar the door, as they say, the barbarians are coming. The reality is that you now have less dollars needing to buy goods that are higher in price. That is going to be ultimately the trouble that everybody is facing the rest of 2022 into 2023. This hyperinflation at a point in time where there just doesn't seem to be enough of a labor force to pay down the cost of these goods. Let's not even talk about what's really coming down the road, which is going to be much higher taxes. You have to understand that the government can only raise money in one of two ways. It can, well, three ways, technically. It can sell goods and services to foreign entities, but in most instances, it's selling its debt, which is creating treasury bills, treasury bonds, and the like, or it's raising taxes on its citizens. Now, I used to tell you that it was hard to sell our debt because our interest rates were so low. Now that rates are rising, we may be able to make somebody think an 8% treasury bond is attractive. Here's the problem. They'll get paid in a weak United States dollar that can't buy their goods at a reasonable price. So you worry about the currency going down. So I've given you all the doom and gloom. 13 minutes into the program, we got 2 minutes left. What can we do, Big Tank? Couple things we can do. First of all, stay away from anything with an interest rate right now. If you can lock in a rate, lock it in. If you are looking for credit cards, get the 0% credit cards and move your balances over and stop charging things. You know, this is the time to be very prudent with your finances. Another thing that you can do is if you're looking to invest, companies tend to not do well during inflationary times. Companies borrow money to grow their business just like everybody else. Companies sell things at prices. When prices are rising and people stop spending, it's not good for sales. When the cost of capital is high for companies, they don't normally grow. So investing in the stock market may not be the best thing in the world right now. The bond market, as rates have to keep going up, the values of bonds come down. May not be the best thing there. What are some alternatives? Gold, other commodities, cryptocurrencies, things that can store value without worrying about the short-term price fluctuations that are interest rate driven. So with that all being said, please join us tomorrow night for the Financial Power Hour, The Cost of Love, Doing Business with Bay. And then I will see you guys back here on Thursday for another episode of 15 Minutes of Finance. Please remember the Wealth Our Way motto. Wealth is not only for the wealthy. You guys take care and have a great